Short exercise 7-12, the general journal. So let's review some things about special journals. So special journals in the manual system, but also in a software package such as QuickBooks, they are used because it's inefficient to record all transactions in the general journal. So we have specific types of journals for specific types of transactions. For example, the sales journal will only contain sales on account. Cash receipts journal, you use that anytime you receive cash. The purchases journal is only for purchases on account, and the cash payments journal is used anytime you pay cash. It's kind of like a check register. But everything else, all other types of transactions, are still going to go to the general journal. So the general journal is going to hold transactions that are not very common, such as the adjusting entries that you do at the end of the accounting period, the closing entries you do at the end of the accounting period, sales returns, stuff like that. So in this problem, they're going to give us some transactions, and we have to figure out, do they go into a special journal, or do they go into this, the general journal? So journalize the transactions below that should be recorded in the general journal. If a transaction should not be recorded in the general journal, we will say no. We will say no entry required. And then at the end of the problem, they will have us identify the special journal that should be used. Assume the company uses a perpetual inventory system. As always, record debits before credits. Select the explanation on the last line. If an entry is not recorded in the general journal for a transaction, select no entry required. All right, so we can see our transactions here, but they also list them here. So on March 2nd, we sold inventory on account to B Kelp, issuing invoice number 501 for $1,000, and the items cost us $680. So what journal does that go into? Well, this is a sale on account. So this goes in the sales journal. So this is not the sales journal, this is the general journal. So you would say no entry required. And in the real world, you'd go and enter that in the sales journal. Next, March 6th, issued a credit memo to B Kelp for $1,000 for merchandise returned to the business by the customer. So remember, in the previous transaction, we sold B Kelp $1,000 worth of goods that cost us $680. Well, now they are returning those goods to us. And it says, do not consider the accounting for the receipt of the inventory. So remember, this is going to take two transactions. So the first transaction will be the amount that we are charging them. The second transaction will be the inventory coming back to us. So first of all, do we enter a sales return, because that's what this is, into the general journal? Yes, we do. So we're going to have to enter this transaction. So let's start with the easiest thing to understand. What happens to the AR? Because remember, we sold this item on account. So what happens to AR for this customer? Well, AR, accounts receivable, is an asset. Assets increase on the left side, so we will have to decrease it on the right side. So I'm going to skip the first line because that's supposed to be the credit, and I'm going to go to the second line and lower B Kelp's AR by $1,000. So what is the $1,000 debit? Well, remember, hopefully you remember how refunds payable works. At the end of the previous accounting period, we would increase refunds payable to represent the amount of future refunds we think we will pay to customers, right? So when we actually pay a refund, we will decrease this account. And to make this understandable, let's think of the extreme example. Let's say all of our inventory was returned. Therefore, there would not be any future refunds at all. So if all of our inventory sales were returned to us, we would have to lower this refunds payable account to 0 because we would have potentially no future returns because everything had been returned to us. So in this case, we will lower the refunds payable account, but of course not to 0. We're only going to lower it $1,000 because that's what we sold to the customer. So refunds payable is decreasing. Issued a credit memo for a sales return. Remember, a purchase return is when we purchase something and then we return it. All right. So the inventory is coming back to us. So we have to go see how much that inventory cost us. You could open this up and see that it costs us $680. Or if you just want to scroll up, we can see that it costs us $680 over here. So our debit and our credit is $680. That's the cost of the goods. So let's start with the easiest one to understand. When the inventory is returned to us, does it increase or decrease? Well, the inventory account is increasing, so that is my debit account. Inventory is increasing. And then the other account is estimated returns inventory. So I'll quickly review that account. Remember at the end of the previous accounting period, we would increase the estimated returns inventory, which would represent the cost of inventory that we think will be returned. It's not actual inventory. So when we get an actual return, we have to lower this. And once we lower this, we will also at the same time, which we've already done, we would increase the inventory account. So we've lowered the estimated returns inventory and moved that number into the inventory account because we actually have that inventory back on our shelves. So let's see here. We issued a credit memo for a sales return. Excellent. Next, purchased inventory on credit terms. So basically we're purchasing inventory on account. Purchases on account go in the purchases journal, not the general journal. So on this transaction, we'll have to say no entry required in the general journal. March 28th, returned damaged merchandise inventory to pawn company, issuing a debit memo for $600. So we can put in the $600 right now, and then we can figure out the accounts. All right. So, since we are issuing a debit memo, that means we are debiting AP. We are lowering our AP. So you issue a debit memo when you bought something on account. So I need to find AP to pawn company. Why am I debiting that? Because remember, AP is a liability. Liabilities increase on the right side. To lower that, I would need to debit it. So by sending them the debit memo, we're saying we no longer owe you the $600 because we're returning this inventory. And then what happens to our inventory when we return it? Our inventory is going down. Issued a debit memo for purchase return. So AP goes down, inventory goes down. And finally, they're saying if a transaction should not be recorded in the general journal, identify the special journal that should be used. So remember these two transactions that we did not enter into the general journal, such as March 2nd and March 21st. We have to say over here what special journal should they have gone into. So the March 2nd one, so I'm going to put the second over here. It says we sold inventory on account. So remember, when we sell inventory on account, when we make a sale on account, that goes in the sales journal. So that's a sales journal. And then the other transaction that we did not enter into the general journal was March 21st. And on March 21st, we purchased inventory on credit, which means we purchased inventory on account, and purchases on account go in the purchases journal. So hopefully this problem kind of helps you understand what types of transactions go into which types of journals.